If you ever try to get your credit score in order, chances are you failed a lot. But the truth is, it's not your fault. You just didn't have the right strategies. So, here are 6 proven ways to lower utilization and push your score past 750. The first thing you should do is understand the statement closing date. So, I remember when I first learned about credit, I thought if I paid my card before the due date, I was fine. And for the longest time, I could not figure a way out to snap out of this cycle where my payment history was clean, I never missed a payment, but my score was still stuck. But then I came across the idea that your utilization is not based on what you owe right now. It is based on what reports to the credit bureaus. And I realized how much of a difference this actually made. Your statement closing date and your payment due date are 2 separate different days. And surprisingly, the next time I paid my card down before the statement closed, my reported utilization dropped. And my score finally started moving. And that's when it all clicked. You need to control what reports to the bureaus. And here's what that means. Number 1, if your score is stuck in the 600s or low 700s, you need to stop only focusing on the due date. Okay, so for example, if you have a $10,000 card and you pay it down to $500 before your statement closes, you report 5% utilization. Number 2, you want to also track every card's closing date. The point is, lenders do not see your daily balance. They just see a snapshot from your statement date. And the better that snapshot looks, right, the better your credit profile looks when you apply. And that brings us to number 2. You need a utilization timing system. So something that I've realized over the years about fixing credit and managing credit is that even if you know everything that you need to do, you could still mess everything up. And I only realized this when I saw people pay their cards on time every month, but still report high balances because they paid after the statement already closed. And again, they could not figure out why until they understood that the credit bureaus only care about the balance that gets reported. And I realized how powerful knowing this was when I started timing payments before the closing date. And surprisingly, without applying for anything new, right? Utilization dropped and scores started improving faster than ever before. And this is when everything started to make sense, right? If you are serious about improving your credit score, you can't rely on random payments or motivation alone. You need a utilization timing system. And here's how. Number 1, log into every credit card account you have and find the exact statement closing date. It is usually listed in the billing or account details section. Number 2, write those dates down somewhere simple. Then before each card closes, pay it down so it reports between 1 to 6% utilization. It sounds very confusing, but in short, you spend a couple minutes a month managing your statement dates, and you protect more points than ever before. The point is, I've seen so many people feel fired up, right? Ready to take control of their credit and change their financial situation, but motivation and willpower alone only lasts so long. After a few weeks, they just give up. The trick is to make the process as easy as possible, right? So it doesn't feel like an uphill battle. It should feel like just taking a walk in the park. The next point is the 30% rule, and this is actually how most people get stuck. The reason people think they are doing fine is because they hear this advice everywhere. Keep your utilization under 30%. But a lot of people don't realize that 30% is not the target, it is the ceiling. Does that make sense? If your goal is to score in the 750s, 780s, or 800s, you don't want to sit at 30%. The people with the highest FICO scores average around 1 to 6% utilization. And I can pretty much tell you this from experience. Every single time someone says, my payment history is perfect, but my score won't move, the first thing I look at is utilization. The best way to still use credit without letting it hurt your score is to trick the system into seeing a very low balance. And the way you do this is by reporting 1 to 6% utilization. And here's how you do it. 1, the next time your card balance gets high, open up your account and check the statement closing date. Don't wait for the due date. Number 2, force yourself to pay the card down before that closing date so the bureau sees a low balance. And if by the end of the month you still need to use the card again, that's fine. But what matters is what reports on the statement date. And that brings us to the next strategy. which is the card shifting rule. And this applies when sometimes you have balances on multiple cards and you need both cards to report low at the same time. Let's say you got two cards. Card A closes on the 15th and card B closes on the 20th. Both cards have a $10,000 limit and both are sitting at a $5,000 balance. So what you do is before the 15th, you aggressively pay card A down so it reports between 0 to 6% when it closes. On the 15th, card A closes and reports that low balance to the bureaus. Now you got a little window between the 15th and the 20th. What you want to do next is move some balance from card B to card A, since card A already reported low. This way, for the next 30 days, it will show that card A and card B both have very low utilization, even though there is some debt that you are just shifting between the cards. Something to note is that when you are shifting these debts, this can cost you a small percentage if it is a balance transfer. So you really have to do the numbers to see whether or not it is worth it for you. The point is, lenders do not see your daily balance. They just see a snapshot from your statement date. So controlling what is in that snapshot is controlling what lenders actually see. Okay, so I recorded this next one after I finished the entire video already because it's just way too good to leave out. But this strategy is to create a utilization map. From what I've seen, a big part of why people struggle to improve their credit score is because they don't know these four numbers, right? I call these the 4 C's. The first number is credit limit. This is essentially the total limit available on each card. Next is current balance. This is how much you owe on each card right now. Next is closing date. This is the date your balance reports to the bureaus. And then you have your credit usage percentage, which is essentially your utilization number. And after you fill out your entire utilization map over here, you're going to see exactly which cards are hurting your score and what you can do to improve it. Now, to find your own utilization map, you can use an app or a simple spreadsheet. Ideally, one that is easy to use and does all the calculations for you and gives you a percentage at the end. Which brings us to one of my favorites. You need to do quarterly credit audits. This is how people find out that their score is not stuck because of payment history. It's stuck because one card is reporting too high, or one old balance is still sitting there, or one inquiry is holding back an approval. Funny story, occasionally people will swear they have low utilization because their overall balance looks small, but when they actually check the report, one individual card is maxed out. And I would never have known about this if we did not do a credit audit. So here's how you properly do a quarterly credit audit. Number 1, every 3 months, pull your credit reports from Experian, TransUnion, and Equifax. Number 2, write down every card, every limit, every balance, and every statement closing date. Next, look through the list and see which card is reporting the highest utilization. If one card is above 30%, that card needs attention first. Next, look for all the other things like late payments, collections, charge-offs, or inquiries that you don't recognize. For the accounts that are wrong, dispute them properly. For the balances that are too high, build a plan to bring them down before the next statement closes. The point is, just like you do spring cleaning for your house, hopefully you actually clean your house, you should also do spring cleaning for your credit because life gets busy, right? And new problems are just going to pop up. So this is just maintenance every couple of months. All right, so moving on. The next thing you need to do is called business credit shifting. And I figured this out when I realized just how many business owners are destroying their personal credit score by running business expenses on personal credit cards, because it's not part of their normal thinking. And chances are they don't even realize the damage. So now what I do is, instead of trying to force every personal card to carry business expenses, I move that spending to business credit cards when it makes sense. Most business credit cards do not report utilization to your personal credit profile. That means the same balance that would crush your personal score on a personal card is basically invisible on the personal side when it lives on a business card. If you are a business owner running expenses on a personal card right now, your personal utilization is getting hit every single month. But if those same expenses move to a business card, your personal profile stays clean, your score stabilizes, and you start looking a lot better to any lender pulling your file. The point is, your brain loves simple systems. So One of the best ways to protect your score is to stop mixing business spending with personal utilization. Which leads me to something that you've got to start accepting. And it's that even if you are trying your absolute hardest to fix your credit, sometimes you still might feel like your score is not moving enough. And that might be because fixing utilization alone is not enough. You might have a late payment here, a collection there, maybe some inquiries that are holding you back from approvals.